Hello and welcome to Nirmal, ladies and gentlemen. I'm Nirmal. We have with us Mrugank Paranjape, Senior Partner at Alpha Alternatives and Non-Executive Director at State Bank of India, joining in. Welcome to the show, Mrugank, and again, congratulations with regards to getting on to the board of State Bank of India as well.
Thank you so
My
much.
first question coming to you know, the kind of impact that COVID is having right now, no one is spared, right? You talk about any economy, there is an impact, any business, there is an impact. What's the sense that you have from here on with regards to how we as a country are going to revive out of this?
So I think first let's just assess in terms of what people have been saying, what we're hearing, and what the general feedback is in terms of what's happening. Starting from when you had some assessments made by some of the multilateral agencies, you had assessments made by economists. The 10-week lockdown estimate was that it could lead to anywhere between a 3 to 4% contraction of the economy. For a country like us, where we were already slightly lower than what we had done in the previous years, that meant we were slowly going towards a near zero. And if by any chance, and that's what I think everybody is a little bit scared, and I think that explains a lot of the psyche, is that what people are really scared is that if there's a second hit in terms of a more longer or even short period lockdown, I think that could really mean a double hit. So in general, predictions are that most global economies are really going to probably be on a contraction mode. Even from the best estimates, probably next door neighbor China could be one of the economies which might expand. From an India perspective, I think we are now seeing estimates which are closer to the 1-2% and somewhere near that in terms of what might be the growth of the GDP in this 1 year. Now, if you juxtapose this to what people used to say about India with its demographics, with its population, that 4-5% is a natural growth for a country like India, which means really in some way or the other we are seeing some contraction. And what does that lead us to? I think the first and foremost is that we will see the overall corporate portfolios, uh, you know, impacted because people are facing problems in terms of their cash flows, and B, more importantly, the risk-taking ability of even corporates has gone down. Corporates, banks, everybody, and therefore you will see investments also low. So it's one of those vicious cycles where the lack of optimism, I think, is going to lead to a slower than expected investments from corporates. All of this will then have probably an effect of a spike in public deficit. And again, we don't know what numbers we are looking at because estimates haven't yet come in. And I think we're definitely going to be much more than 3.5% that we were targeting as the economy. It's really how much more will it be. I think there are some silver linings, though. I think the first and foremost is that in spite of everything, oil prices seem to be in our favor. And for a country like India, which is so dependent on oil imports, the oil price seems to be one good thing going for us. If you also see, I think the general rural economy and the overall impact of the rural economy hasn't been that much in terms of some of the factors which go underlying factors in agriculture. So I think we may not see too much of an inflationary hit, and I think that's the positive thing that we see. So for the next 1 year, again, very low growth rates, but hopefully with some of the factors which I mentioned, also tamed inflation, and that may allow us to do something more creative in the economy.
Right. And that's a good point that you've made as well, Nugang. And everyone right now is talking that yes, there will be a recovery. Now, there are options and permutation combinations that everyone's using, whether it will be a U-shaped recovery, a V-shaped recovery, or is it going to be some bit of stagnation right now? What's the sense that you have on that front?
So I think anybody who could predict, I think, would be really an expert, or even more than that in terms of the economy. But and it's also how you compare data. Just talking to a fund manager last weekend in terms of why there was some sort of sense of optimism. And his whole point was that, everybody knows that in April hardly any cars were sold. And therefore, in June, if you sold some cars, that's still a great positive growth. So I think it's the way you look at some of the data points. But in terms of the recovery, I personally think there will be a couple of things. One is from a sentiment perspective. I guess a lot of people are looking at the numbers that people are tracking on the COVID cases, especially the active cases, because the expectation is that as long as the active cases stabilize and then you start looking at a downward trend, public at large will feel much more confident about the fact that this whole pandemic is coming towards some sort of semblance of control. I think what is, of course, the biggest thing which could create a positive spike and that way then generate a whatever hockey stick effect, a U or whatever we call in terms of recovery, in terms of sentiment, is when we actually see the results of either a vaccine or a cure, whichever way we are looking at it. So I think those will be the two factors which people are looking for. But in general, I still believe the recovery will be slow. It's not something which is going to happen very fast in the next 1 week.
Right. And the anticipation is, and right now is that it's the rural economy, tier two, tier three cities, which are going to see a bounce back faster than the urban areas as well. Are you of the opinion?
So I think some of the factors which we must consider is that, again, historically, what has been a little bit of an issue for us that too many of our people are staying in the smaller cities and rural areas, and there is a lot more dependence on agriculture, etc. In the past has been something which we always thought was a burden, but look at it in a different way. One, from a pure consumption perspective, actually, it's good that you have agriculture as the mainstay of so many people. The second, and that's a data point which we at our firm have been tracking as well, is around the entire monsoon and its impact. So, in India, we've always been dependent on monsoons. And at this point of time, we are, the data suggests that, last year itself, we were at a situation where the water table going into this season was at a 10-year high. All indications in this monsoon are again that the monsoons will be good. Coupled with that, the acreage numbers that are coming in are again positive. So most of it gives you a sort of impression that we're really going to see good production coming in from the agricultural sector. Now, of course, one, again, slightly pessimistic could be that if there's too much production, prices may fall. But on the other hand, we're still seeing the sort of breakages in the supply chain, and we're also seeing a lot of countries who may have a lot of demand for some of this. So I would say, in balance, agricultural prices, as long as they don't really go down too much because of a good harvest, you would actually see, as you rightly pointed out, recovery probably being led by the consumption and demand coming from the rural or semi-urban sector.
Right. And with this, again, if you see the kind of disposable income people are sitting on, especially in terms of rural India, is way higher versus urban area. Now, the question that comes in, Mrugank, is for a retail investor is, where should I invest? How should I invest? How much should I invest? And is this the right time to invest? What would your advice be to investors at this point in time?
So I think the first and foremost is that this is a time to definitely be a little cautious in terms of your way of looking at investments. The one thing which I would not do is start doing completely new activities. So if you do not have the information, the ability, the expertise, or the advice, whichever way you are getting that for investing in a particular class of assets or investing in a particular product, this is probably not the right time, because even the experts are themselves not 100% sure. I mean, we've seen rallies in the capital markets, especially in the equity sectors. But if you really ask people what is driving this, other than liquidity, people are not really sure of what is driving those rallies. So at one point of time, you are not very sure of what is driving some of the asset classes. And therefore, the first thing which a retail investor should not do is to try something which is new, which is not known to them. The second thing, and I always say this, is that you must look at your own asset allocation. You must look at your own asset allocation from the perspective of a risk appetite, from the perspective of a goal setting. If you are really looking to a capital preservation for some event, you want to keep some part of your money and you want to be very safe about that part of the money, then look at those assets which will give you that safety in today's world. Of course, if you have made an allocation towards riskier products like equities or even other riskier products, by all means do that. But don't change your asset allocations abruptly. In fact, a little conservatism might help you. In that sense, and I know gold is completely rallying and there's a huge temptation to suddenly start investing in gold. But again, don't do that if you didn't think gold was supposed to be a part of your asset allocation. And if it was, then you are on a great wicket because you probably have made a good ride based on your asset allocation. So I think keep watching your asset allocation. In the asset allocation, as we keep advising people, you need to sort of align your goals first to your assets. So if you're looking for steady income, you're looking for steady returns, you do not want volatility. Look at products which give you some opportunities for arbitrage. Look at products which really give you a steady income. In the current times, we've already seen that even some of the so-called income products from debt funds really are not steady income. They could actually be more volatile. So again, first and foremost, this is not the time to start doing new things. This is not the time to start taking risks. And as much as possible, and I think all of us have a lot of opportunity and time at hand, educate yourselves about the risk return profile of the products that you're looking at before starting to make allocations.
Right. So absolutely well said that, in terms of the risk-taking appetite as well as goals, both need to be taken into consideration. So Mrugank, if someone is a conservative investor, what according to you would be the best asset classes right now?
So I think we always look at this not first with the asset class, but like you rightly said, in terms of the risk return portfolio that you're looking for. And if you're risk averse, if you are conservative, then what is very important for you is conservation of your principal, even if it may come at a slightly lower but a very steady return again. And again, a slightly lower return just doesn't mean a volatile low return, but a steady low return. I think from a product perspective, we believe that genuinely managed arbitrage products, and arbitrage products can be in any asset class. You can have a commodity arbitrage product, you can have an equity arbitrage product, but as long as it is managed well, it is managed within the parameters, it is managed true to the aspect that it does not take a price risk, because that's what an arbitrage product is supposed to do. It is supposed to be agnostic to the price. Those are the sort of products which will give you a steady return, which will give you a non-volatile return. In all probability, it will still be better than a bank deposit. But yes, if that is what you're looking at, then depending on the safety that you see in some sort of banks that are there, I think some of the banks in India are extremely rock solid. You could look at just putting your money in a bank deposit, but then that is really on the lower side of the returns.
Right. And with this, again, the progress of the economy is something that we're watching out for. For India especially, a lot of people are of the opinion that probably India has the opportunity to bounce back really faster. How fast they make use of this opportunity is something we need to see. Do you think we will be able to supplement China on the manufacturing front, maybe not take them over, because we've always been known as the back office hub of the world, and now to replace or even supplement China, do you think that's a big possibility?
So I think we should look at this as an opportunity, but with a little bit of realism. And I'll tell you why I say so. First and foremost, let's look at what most of the reactions in the world have been as part of the COVID crisis. I think, and there are a lot of these numbers coming up. There are about 90 governments which have currently blocked export of medicines and medical goods to preserve supplies. There are at least about 40 sort of plus governments which have stopped in 29 categories, they've really not allowed exports to happen. Again, people are just trying to conserve their own resources. At the same time, there is at least another 160 export controls which have come in the last few days. So I think the first immediate reaction from many people has been that they are being very conservative. They're trying to sort of keep their own resources within their own countries. And the second thing is that many people are always going to look at this as an opportunity to start becoming more self-reliant. So I think there will be a lot of pressure to become self-reliant. I think government of India has come up with a very, very good initiative and is pushing the Atmanirbharta campaign. But this is where, coming to your point, China did not become the manufacturing backyard of the world in a couple of years. From what most people would remember, it was probably a 2-decade sort of journey which China did. This includes having the infrastructure, not just when we say infrastructure in terms of basic roads and electricity, etc., but also in terms of the logistics infrastructures. Do you have that many ports? Do you have that much infrastructure to handle inward and outward exports, imports? Will you be able to actually replicate and replace the supply chains which have been set up across these? So I think a realistic thing for India would be to first say, can we make sure we take care of this opportunity and start becoming self-reliant? I think self-reliance would be the first goal. The whole Atmanirbharta is what I think we should be looking at. To become to supplant China, I think in the short run, we should be looking at us being the second option. We were just a couple of weeks back talking to a very, very senior diplomat who just retired from the foreign services and who made the very same point. He said, you can't replace China immediately. Yes, that's a good goal to keep in the long run. In the short run, let's make sure we are self-reliant. And second, let's start becoming at least the second option so that people can start thinking and moving their supply chains. So that's the way I would look at how I think it will progress over the next couple of years.
Absolutely. And with this as well, another aspect, which you've been an expert at is with regards to the commodities market is concerned with the background that you come from. Now, with the commodities market, you are actually trading raw materials. Now, do you think it's a good trading avenue for retail investors? Because again, if you see the shelf life with regards to commodities, it's way less as compared to equity markets, right? So do you think it's a good investment bet for a retail investor, or do you think it's more of a trading bet?
So I think let me explain this, and I've always done this even in my previous job, that I used to always say that if you're a retail investor, I think you should not look at commodities as a pure investment unless you can do a couple of the following things. So what are those? I think a fundamental understanding of a commodity is a must. Why I say that is that unlike a security on a stock where to some extent, yes, you need to understand the business of a Reliance or a business of Infosys before investing in that company. You don't really need to know the entire nitty-gritties of that company. Whereas if you were to start investing in, say, Castor, or if you were to start investing in copper and hold that as an investment, you need to have a very, very deep understanding of that commodity itself. Now, that takes time. The second and the biggest thing is that holding commodity comes at a slightly higher ticket because you can't really hold one bag or one sort of ton of copper. You'll have to really hold what is a tradable lot in the exchange. That itself becomes a slightly higher ticket size. The third thing is that holding physical commodity means you need to have the ability to manage the physical end, which is you need to have the linkages to the warehouses, you need to be able to manage GST, etc. So I think today, if you ask me in terms of the trade-off between all these things and in terms of being able to invest in commodities, and especially since I mentioned earlier as well that commodities is a very, very good opportunity in terms of an arbitrage product, I think it is still a product for the slightly higher end of investors who can manage all of this and invest slightly higher amount of sums of money. For a pure retail, this becomes a trading bet. I think where is the silver lining to this? Because this is something which I have personally believed in the last 5+ years. I think the real silver lining is in the fact that SEBI has been going very actively in trying to institutionalize the market. So July 2017, alternative investment funds were allowed to invest into commodity derivative markets in India. 2 years later, in 2019, mutual funds were allowed. We had a small issue in terms of some of the operationalization of all these, which was also addressed by SEBI in sort of around April, May of this year. So I think today, genuinely, there is a mutual fund, there is alternate investment funds, all of which offer a retail investor the opportunity to invest in commodities purely as an investment rather than a trading avenue.
Right. And in the commodities market, Mrugank, right now, where are you seeing traction? Because we know what's happened with oil. We know what's happening with gold. Silver's trying to play a catch-up rally as well. Base metals have been reacting in a different way altogether. The quantum of volatility is really high. Where do you see the traction right now?
So I think first and foremost, as we know, volatility is what makes a market very active. Volatility is what drives a lot of the trading activity in the market, and which in many ways is good, because when you have volatility, you have a lot of volume. And one of the things which we are really needing in this market in India is good volumes, whether it is on the two exchanges which trade commodity derivatives or even otherwise. I think a good volume is something which is absolutely a must. So I think the first and foremost thing I would say is, in fact, some amount of volatility like the way we are seeing is a good thing in terms of commodity trading, and that's something which you see as a positive sign. In terms of asset classes, again, like I said, whether it is a crude which was completely looking headed south at one point of time, went negative, whether it is metals which have been really, really performing well. I would say there are opportunities definitely in both metals as well as in gold. Gold has been doing well, and if you look at the peculiarities about gold, from an India perspective, an Indian investor's perspective, it is really fixed with sort of the international price. You look at the exchange rate, you look at the overall dollar strength, the US dollar index. Surprisingly, this is one time when, while normally during crisis times, the correlations between these have gone down. Currently, the correlations are pretty high. So international prices are going up. They seem to be going up more because everybody is looking at gold as the safe haven, but there are also the interruptions in the refining industry and the whole supply chain, which is driving the prices up. The dollar index is declining, and therefore, by the same correlation, prices in India are rising. So I think from a medium to a long term, the gold as an opportunity does look good. Of course, as I said, it's also in terms of how much allocation you want to make to that asset class that you should look at gold. Gold and silver, as we all know, have some sort of correlation. It does go away in some times, but I think in general, between the two of them, you should just make a choice between which one you would like to really invest into. Metals, again, as the demand is coming back, and one of the things we are seeing, and when we had the famous crude oil going negative, you had people who are willing to actually buy and store crude oil in tankers. But what that really tells you is that the ability or the willingness of a lot of people to invest into commodities, to hold them because they believe that demand is going to revive, is really coming back. So I think that is one thing which we believe, that from a pure investment perspective, there is definitely a view building up that people would like to invest and hold some of the commodities because they see demand reviving, and that is probably driving what is happening in metals.
Absolutely. And Mrugank, you have headed MCX as well, successfully steered it with the kind of implementations that you've done with regards to reforms. How do you see the Indian commodities market itself doing from here on? What are the kind of reforms which are yet required and you would recommend going forward to get the next level of growth in this segment?
So I think, to this, we must look back to 2015 when SEBI became the regulator for this market. And I think SEBI created this framework, they call it the SEED Act. A lot of us were participants in that. We contributed. SEBI has actually taken care of most of the recommendations. Now, if you look at what we had said that time, they said what you need really in this market is products, which I think is great. SEBI has almost given all the products which the market was asking for. We wanted options. Options have been allowed. Later on, there was a demand to allow not just options on futures, but option on the underlying commodity itself. Even that has been allowed. The next set of products which everybody wanted was index. That again has been allowed. The second thing which we all wanted was participants. We said, we need institutional participation. That is key for the growth of this market. It's taken some time, like I said, but it is there. I think the only piece missing in terms of participation even today, and from that perspective, again, I think the regulatory piece has almost been done, which is where SEBI, through its LODR, has already made it sort of mandatory for listed companies at least to talk about what is their exposure in commodities. So I think the big push that is needed is in terms of getting more physical market participants to come into the commodity derivatives market in India. Where I think we need to do a little bit more, and again, one part of it has happened, is in the creation of the WDRA, the Warehouse Regulatory Authority. I would think that the whole electronic receipts that they have now started issuing under the WDRA is the next stage of the reforms that we need to really, really make sure that they click. And again, you go back in history, the depositories were formed in '96. It wasn't until 2001 that it became mandatory to deal in electronic stock. And then, equities market just took off. So I believe one of the key things which will be a driver for reforms and the real growth of this market will be the proliferation of electronic warehouse receipts. So one, we need to make sure that the ENWRs cover the non-agricultural market, which they currently don't. And second, we need to just make sure that everybody comes under the purview of the WDRA, and we make that a much more heavier organization with a much wider scope and coverage. So I think that's one reform which I definitely think we should look forward to. Beyond this, I think it's also time for all of us in the industry to now say we've seen all the reforms that we wanted. Let's spend the next few years trying to build on those and make it a big market. Personally, I always have been for the last 5 years, and I still remain very bullish on the growth of the commodity markets in India.
Absolutely, and the kind of volumes that are picking up also is really encouraging. The kind of indexes that they're building, where someone can buy bullion, directly from the exchange in terms of an index. You can buy agri commodities the same way. Weather derivatives is something that they're introducing as well. So yes, I mean the growth that we are looking at in the commodities market looks immense from here on as well. But thank you, Mrugank. Thank you so much for joining us on the show. It was a pleasure having a conversation with you. Great insights that we picked up. I hope you enjoyed the conversation as well.
Thanks a lot, and all the best to all of you at Nirmal.
Wish you the same and stay safe.